Welcome to this explainer. Let's kick things right off with a number that is honestly pretty incredible. 23. We're talking about 23 consecutive profitable quarters. And keep in mind, this is for an ethanol producer operating in a commodity market that is notoriously cyclical and, frankly, highly volatile.
Now, that record-breaking profitability, it was just front and center in the latest earnings call with CEO Zafar Rizvi. He basically stated they delivered the best first quarter on a net income per share basis in the company's entire history. That's a bold statement, and it absolutely sets the stage for the financial teardown we're going to do today. I mean, we're looking at a company clearly doing something very right in a really tough industry.
So, welcome to the masterclass. Today, we're going to run Rex American Resources through an absolute gauntlet of legendary valuation frameworks. We're putting on our expert investment analyst hats, and we'll use the exact methodologies of some of the greatest investors in history. The goal? To see if Rex actually deserves a spot in your portfolio.
Here's our roadmap. We'll start with a quick company snapshot, then test Rex through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern DCF modeling, and finally synthesize it all into a definitive verdict. Let's get right into it.
Okay, Section 1, Rex Company Snapshot, Ethanol and Beyond.
Rex is currently trading under the ticker REX at exactly $43.94. Right now, this company has an effective ownership of about 300 million gallons of annual ethanol production. But you know what makes them genuinely fascinating right now is where they're expanding. They are aggressively investing in these high-upside Class 6 carbon capture and sequestration projects at their One Earth Energy facility. Basically, they're positioning themselves to capitalize on some major new federal tax credits.
Moving on to Section 2, the Warren Buffett lens. Seeking the moat.
We all know Warren Buffett doesn't just buy stocks, right? He buys businesses. He demands a distinct economic moat, remarkably consistent earnings, a high return on equity, and rock-solid financials before he even attempts to calculate owner earnings or look for an intrinsic value. Now, in a commodity business like ethanol, finding a traditional economic moat is, well, it's tough. But here's the kicker. Rex is actively building a regulatory moat right now through those carbon capture investments and being an early mover on Section 45Z tax credits. And their financial data perfectly illustrates why Rex would absolutely catch a Buffett-style investor's eye. They boast a totally resilient balance sheet. We're talking over $364 million sitting in cash and short-term investments, and get this, absolute zero bank debt, nothing. When you pair that kind of financial fortress with a solid 14.2% return on equity and 23 straight profitable quarters, yeah, management is clearly proving they know how to allocate capital. But because Buffett always demands a strict margin of safety on future cash flows, a Buffett investor would likely hold off for a slight discount, probably targeting an entry somewhere around the $38 mark.
That brings us to Section 3, the Peter Lynch lens, growth at a reasonable price.
Now, Peter Lynch loves categorizing a company first to really understand its trajectory. Is it a slow grower, a stalwart, maybe a cyclical? He also heavily weighs the PEG ratio, dividing the price-to-earnings multiple by the earnings growth rate. And maybe most importantly, he absolutely loves to see company insiders putting their own money on the line. Think about how perfectly Rex fits into a classic Lynch play. First, we categorize it as a cyclical stock because of its commodity dependencies. And honestly, it passes Lynch's task with flying colors. Why? Because it rocks an incredibly cheap PEG ratio of 0.37. That means its PE ratio, which is roughly 15.7, is completely dwarfed by its massive historical earnings growth. And when you combine that dirt cheap PEG ratio with some recent massive insider buying, specifically the CFO Douglas Brueggemann scooping up 133,000 shares, well, a Peter Lynch investor would probably be buying this stock right this second.
Let's pivot to Section 4, the Benjamin Graham lens, the defensive investor.
Benjamin Graham is a whole different ballgame. He completely removes all emotion and speculation. He relies entirely on a really strict 5-point defensive checklist and a super rigid intrinsic value formula to calculate an absolute margin of safety. Basically, if the math doesn't work out perfectly, Graham just walks away.
Running Rex through Graham's rigid checklist actually gives us a bit of a split decision. On one hand, it passes his tests for adequate size, a strong financial condition, it has a current ratio near 6, and it shows long-term earning stability. But it ultimately fails the overall defensive test. It fails because it offers a flat 0% dividend yield, and its combined PE and price-to-book multiple is just too high. It exceeds Graham's strict maximum threshold of 22.5.
Still, If we push forward and actually calculate his famous formula using an estimated base EPS of $2.50 and a tangible book value of $19.10 per share, Graham's exact intrinsic value spits out at $32.77. So what does that mean for us? It means that at the current price of $43.94, a strict Graham investor wouldn't even think about holding. They demand an extra 30% margin of safety, basically waiting for a massive dropdown to around $22 before they'd even consider touching it.
All right, moving out of the history books. Section 5. DCF and Alternative Models. Modern Mechanics.
A discounted cash flow, or DCF model, values a company based purely on the actual cash it's going to generate in the future. Right now, REX trades at roughly 31.5 times free cash flow against a $1.45 billion market cap. So we can extract a pretty conservative base of around $45 million in free cash flow to start building out our DCF base case.
When we run those projections, assuming a standard 10% weighted average cost of capital, a really conservative 5% growth rate for this cyclical business over the next 5 years, and a 2% terminal rate, our base case DCF fair value lands right around $48 per share. And if we tweak those assumptions across a sensitivity matrix, it gives us a fair value range between $40 and $58. So we're definitely seeing some moderate upside from where the stock sits today.
But we always want to cross-reference with some alternative models to be sure. If we compare Rex's 17.6 trailing PE ratio against a massive industry peer like ADM, which is trading way up at nearly 36 times earnings, that suggests a much higher relative fair value of $65 per share, assuming Rex gets awarded that kind of industry premium multiple. On the other hand, a standard EV to EBITDA model points closer to $46, which actually falls right in line with our DCF base case.
Okay, the moment of truth. Section 6, Synthesis and Final Verdict.
When we literally line all these valuations up side by side, we get a pretty massive spread. We've got Graham's ultra-conservative $32 floor way down on the low end, and that peer comparable ceiling of $65 on the high end. The current price of $43.94 actually sits very comfortably right in the middle. It's just slightly below our EV to EBITDA and DCF base cases of $46 and $48.
But to make a final call, we have to weigh the qualitative factors, right? On one hand, Rex has some incredible strengths: a flawless, literally zero debt balance sheet, serious executive insider buying, and those highly lucrative new 45Z tax credits that will pad their gross profit. But on the flip side, we have to respect the real risks. We're talking about highly cyclical energy markets, a slightly bloated price-to-book valuation, and those ongoing EPA and Illinois state permitting delays for their vital carbon pipeline.
So blending all these analytical insights together, our final recommendation for Rex American Resources is a hold at its current price of $43.94. The stock appears to be fairly valued today. Don't get me wrong, it is a fantastic business, but the margin of safety just isn't quite wide enough for a conservative value investor right now. That being said, a Peter Lynch-style investor might comfortably jump in right this second based on that awesome low PEG ratio and heavy insider buying. Meanwhile, Buffett is sitting back waiting for a dip to $38, and Graham is basically waiting for a market crash to buy in at $22.
I'm going to leave you with this final thought to ponder. As federal incentives shift and environmental regulations tighten, could Rex's ambitious pivot to Class 6 carbon sequestration completely redefine its economic moat and break it out of this cyclical valuation? It's a fascinating regulatory space and one you absolutely need to keep on your watch list. Thanks for joining this masterclass explainer.